Today we are going to discuss Employee Stock Purchase Plans, ESP. Here are the contents. Buying company stock at a discount. But what about taxes? How much of the stock sale price is compensation and how much is capital gain? Buying company stock at a discount. Why companies want to do that? Many large companies offer employee stock purchase plans ESP that let you buy your employer's stock at a discount. These plans are often offered as an employment incentive, giving you an opportunity to share in the growth potential of your company's stock and, by implication, work hard to keep the stock price moving ahead. How to buy and what price to buy. Usually, you make contributions to a stock purchase fund for a certain period of time through payroll deductions. At designated points in the year, your employer then uses the accumulated money in the fund to purchase stock for you. In many plans, the price that you pay for the stock is the stock price at the time you started contributing to the fund, or the stock price at the time your employer purchases the shares on your behalf, whichever is lower. With a discount of up to 15, your discounted price is known as the offer or grant price. For example, you want to start the ESP purchase in the middle of this year, let's say 2025. Normally that means you can start to contribute from July 1, 2023 and end on 12/31/2023. Each month you will contribute 10% of your after-tax salary, which is $305. The total accumulated contribution is $1,830. The stock price is $116 on the grant date July 1, 2023 and $153 on the purchase date December 31, 2023. The purchase price will be 85% of the lower price, which is 116 times 85 equals 98.6. The company will buy 18 shares of stock for you. The leftover $55.2 will be rollover to the next ESP session. But what about taxes? When the company buys the shares for you, you do not owe any taxes. You are exercising your rights under the ESP. You have bought some stock. So far so good. When you sell the stock, the discount that you received when you bought the stock is generally considered additional compensation to you, so you have to pay taxes on it as regular income. If you hold the stock for a year or less before you sell it, any gains will be considered compensation and taxed as such. If you hold the shares for more than 1 year, any profit will be taxed at the usually lower capital gains rate. How much of the stock sale price is compensation and how much is capital gain? There are two situations: qualifying disposition and disqualifying disposition. For qualifying disposition, you sold the stock at least 2 years after the offering grant date and at least 1 year after the exercise purchase date. If so, a portion of the profit, the bargain element, is considered compensation income taxed at regular rates on your Form 1040. Any additional profit is considered long-term capital gain, which is be taxed at lower rates than compensation income and should be reported on Schedule D, Capital Gains and Losses. For disqualifying disposition, you sold the stock within 2 years after the offering date or 1 year or less from the exercise purchase date. In this case, your employer will report the bargain element as compensation on your Form W-2, so you will have to pay taxes on that amount as ordinary income. The bargain element is the difference between the exercise price and the market price on the exercise date. Any additional profit is considered capital gain, short-term or long-term, depending on how long you held the shares, and should be reported on Schedule D. Now we can have three situations. Situation 1: disqualifying disposition resulting in short-term capital gain. In this situation, you sell your ESP shares within 1 year or less after purchasing them. This is a disqualifying disposition sale because you sold the stock less than 2 years after the offering grant date and a year or less after the exercise date. Please check the process for 20 seconds to see how this was calculated. Situation 2: disqualifying disposition resulting in long-term capital gain. In this situation, you sell your ESP shares more than 1 year after purchasing them, but less than 2 years after the offering date. Please check the slide here to understand the calculation process. Situation 3: qualifying disposition with stock price increase between offering date and purchase date. In this situation, you sell your ESP shares more than 1 year after purchasing them, and more than 2 years after the offering date, and the market price actually increased from the offering date to the exercise date. Here is the similar calculation. Please take your time to understand the process. And thank you for watching this video. Goodbye.